So CFD falls under that category because its value is derived by an underlying asset. So let's get on with tonight's class. Now, tonight we're going to be talking about what's the big word that scares everybody to death? Technical analysis. It's a big word in our industry. Now, unlike fundamental analysis, which focuses on finding a security's value, economic reports, political events, technical analysis is based on the belief that past market trends can predict the future behavior of the market as a whole, and for individual stocks or individual assets. Okay. Now, there's lots of parts of technical analysis. It's a very broad field with a big naming, big sounding, scary name, technical analysis. Well, let's take the word technical analysis, throw them in a trash can. I hate them. Let's make it easier to understand. Let's make it less scary. Let's call everything that falls in that field chart analysis. Because what all technical analysis, in our case, is something we do on our charts. We're looking and reading and interpreting our charts. Whether we're putting a technical indicator on the chart, whether we're looking at price on the chart, whether we're looking at formations and chart patterns on a chart, whether we're trying to read Japanese candlesticks, it's all chart analysis. We're simply analyzing what price action is trying to tell us with our charts. Now, there's certain aspects of technical analysis that are very controversial, such as the belief that markets move in trends that can play out over long periods of time, and the contention that market action can detect shifts in supply and demand relations. Well, it's really true, except in our type of trading. Okay, remember, we're not investing, we're trading, number one. And even though CFDs can be held for as long as you wish to hold them, we're talking short-term markets. Okay. The average CFD is closed within a day, 24 hours. But you could keep it open for 3 days, 5 days, 7 days, 9 days. Okay. But it's a very short period. And to be honest with you, all this up, we talk about technical analysis, supply and demand. Okay. The historical price to the future price, all of this really doesn't relate to us much. Yeah, if you're looking to understand the value of Google and where Google should be in 3 months from now, or 6 months from now, or what the actual value of Google should be if you broke down all their assets against all their debts, against all their shareholders, and come up with an actual number that you think a share should be worth, okay, that's all fine. But that doesn't help us, you and me. We need to understand what the price is trading at now, not what its value is. We should have some general idea. But if Google is depressed because Google is trading at $145 when it should be really at $160, okay. If I'm going to buy shares in Google and put them away for my kids' graduation or my kids' college, okay, I hope they're worth 160 if I buy them at 140. I hope they go to 180, 190 eventually over the next few years. But we're only concerned with Google should be trading at 150. It's been trading at 148, 149, 150, 151. For some reason this morning it fell down to 143. We don't really care what caused that reason, what the actual value of Google. We only care if Google will climb back to 151 today. Or will it fall from 143 to 141 today? That's all we care about. We care about where prices is now and what it's going to do over the next few hours. We care about volatility, we care about volume, we care about speed, we care about momentum. We don't care that Google's really worth $163 because it's not going up to $163. So in order to do this, we use trends and patterns, some with odd names like rectangles, triangles, Bollinger Bands, inverted head and shoulders, candlesticks, MACD histograms, stochastics, on and on and on and on. But in order to apply any of these, first you need to be able to read a chart and know how to use one. Now, it is important to understand that the realm of technical analysis is not limited to just charting, but everything we do for technical analysis is done on our charts. So some academic studies say technical analysis has little predictive power, but other studies say it may produce returns. The fact is, all technical analysis you're going to be faced with, or chart analysis, all comes down to either reading price action on your charts or using indicators and oscillators. Well, these indicators and oscillators all have basically one thing in common. Now, they're all made up of involved mathematical statistical calculations. But to start those calculations, they need a basis of numbers. And what do they have? They have the open, the high, the low, the close, and possibly volume. That's the only numbers they have. Now, you could be looking at the open for 100 days ago and the close for today. You could be looking at the high and the low for the close of the month. But you always have to use the open, the high, the low, and the close, or any combination thereof. And every indicator uses a different assortment. And then they start doing their statistical analysis or their mathematics to those numbers. Fact is, those numbers have already happened. They're not using any tomorrow's numbers. They're using past numbers. So we have a little problem there because all technical analysis starts with what we call lagging information, because it excuse me because it lags behind the market, because it's using, even if you're using the smallest time frame and you're using the close from the smallest time frame, you're using numbers that already had to have happened. So all of these mathematical formulas and statistical formulas are trying some way or another to make or limit this lag. And really the only thing we can do is combine these indicators and oscillators with these chart patterns with what? With price. Because the only thing that's moving is price. And the only actual indicator that's always right is price. So when we look at our charts, okay, we can put all the complicated stuff we want on our charts. But it's all going to come back to number one is being familiar with your charts, understanding how to read a chart, and what you do with these charts before you apply your analysis. Now, ultimately, when we start charting, okay, there are three basic types. There's all types of variations out there. So before I tell you there's a bar chart, a line chart, and candlestick chart, and somebody's going to go off and ask me about this Helsinki stuff out there, these are all variations of some type of chart. But the three most common charts are candlesticks, bars, and line charts. And everything else is some type of a variation. Now, today, we're very lucky because when I started charting, we did charting by hand. We didn't have computers. Okay, we used ticker tapes sitting in the pits to give us price, and we're sitting there with graph paper and pencils like all those little nerds you see in the movies with our pencils and our pocket protector, drawing our charts on our graph paper. So in those days, most of us used bar charts because they were just easier. Now each bar, and bar charts are still very popular today. Each bar represents the open, the high, the low, and the close for the period of time that you're looking at. Now in this case, we're looking at my standard teaching chart, which is the Euro US dollar 30-minute chart. So each one of these bars represents that 30 minutes. It's the open, the high, the low, and the close that occurred in that 30 minutes. If I change it to a 1-hour chart, each one of those bars still represents the open, the high, the low, and the close for that 1 hour. Now, looking at different time frames will help you down the road make better trading decisions. But as I said, we only have 3 basic choices of charts. The line chart doesn't do us any good. They're really a waste of time in our type of business. Because the the line chart puts a dot on your chart. In this case, we're back in my 30-minute chart. The close of every 30 minutes, we put a dot on the chart and we connect those dots and we can see some general information, but it doesn't give us any specifics, and it doesn't usually give us the right information because it's only giving us the price at the close. So the price could have been trading for that same half hour way higher and just fell at the close. And so what you're seeing is a way low number, but actually the market was trading pretty strongly. Now, when I started trading, and the rule of thumb in all bar charts was they used the close of that trading period as their basis. Now, the fact is, it won't change anything if you use the open. It won't change anything if you use the high. It won't change anything like you used the low, because in this case, it's just in a bar chart, in a line chart, it's just random happenstance of what price was doing at that time period. But unfortunately, excuse me again, winter is arrived. Okay, what's happened is these wonderful, let's take about wonderful developers who have developed these new HTML charts that are so advanced and make life so easy for us, have given us way too many choices, because they would just develop everything with not understanding the world of trading. So we actually now have we can have a bar chart, a line chart based on the open, the high, the low, the close, or the high and the low divided by 2, the high plus the low plus the close divided by 3, the open, the high, the low, and close divided by 4. Okay, none of them are going to make any difference to any of us. And also, there's such tiny, minuscule differences in those numbers that it's just a waste. But be careful. There's too many gurus out there that really aren't gurus. They're trying to give you a system that you think they're brilliant. And they'll tell you, well, you know what, if you use a line chart based on the open, the high, the low, and the close and divide it by 4 and use that, you'll get a good trade every time. I don't need to say more. Just like, but there's too many people. But that's enough on the line chart, because the line chart doesn't do any of us any good. The bar chart, as I mentioned, used to be extremely popular and is somewhat still today, because of these developers. Now, a bar chart takes and puts a doohickey to the left at the open, puts a doohickey to the right at the close, puts a dot at the highest point and a dot at the lowest point. It connects the high and the low. And what you get is like a little ladder. Open, close, high, low. And this forms your bar. If it happened to open here and close here, you had your high there, your high there, you would have a doohickey with the to higher up. So if you're stepping up the ladder from the open to the close, you had a positive trading session. If you're stepping down the ladder from the open to the close, you had a negative trading session. Now, our wonderful developers have given us the ability, and this is an interesting one. I used it for quite some time, okay, because I wasn't big on candlesticks. But our wonderful developers now let us set our bar chart from being black, which is what it always was, to add reds and greens. So it mimics somewhat the candlesticks. Now, because when we used to sit in the pits and trade and chart by hand, we had pencils in our pockets. So all of us basically used bar charts because candlesticks, first of all, those years we didn't have magic markers. We did have color pen, but to sit there and color in blues and greens or reds and greens was time consuming, and you didn't have the time when you were hand charting. You were doing things very fast. So we just used our pencil and made the bar on the charts. Candlesticks took a little bit more time, but today they are the most preference and most well-used charts because now that they are all available on these HTML charts, so we can jump back and forth, we can easily put candlesticks on our charts. So they are the most popular trading chart out there today. But the fact is, these wonderful charts today allow us to jump back and forth easily from bar charts to candlestick charts, because sometimes a bar chart, especially if you don't have it colored, will help you see something you might not see in a candle. So if you're sometimes you might say, let me pop it over to a bar and see if I can see this clearly with less color. Now, the fact is, when I was hand charting, and there were some odd and end guys who used candlesticks in, we had what we call black and white candles. Now, every candlestick does the same thing as basically as the bar chart, same piece of information. For a candlestick, you put a line across at the open, you put a line across at the close, you put a dot at the low, a dot at the high. You connect these, what we call in candlesticks, wicks or shadows, to the bars, and then connect the bodies of the bars together to form this candlestick. But these bodies and these wicks are easier to see in candlestick formation, and they really tell you the story of price. And that's why candlesticks help us so much, because we can interpret the markets better by looking at the size of the body of the candle, the width of the wicks, and these highs and lows made by the wicks of the candles. The color isn't as important. Now, as I said back in the old day, and this is kind of important, is we were hand charting. So the guy who was doing candlesticks would be just using his pencil, drawing it just like this. And if it was a positive trading session, he would leave the candle hollow, open. If it was a negative trading session, in other words, a bearish session, or there was a drop from the open to the close, he would use the side of his pencil and color it in. And so this became known as the black candle, and the hollow one as the white candle. The only reason I tell you this is because it's important, is based on the fact that a lot of material you'll read today, and even some of the names of the candlesticks, are blacks or whites. You'll read about 3 black crows or 3 white soldiers. Well, nobody had reds and greens then. Okay. So we have black candles. Reds and greens have just become very popular in our industry and our charting. But the fact is, hold on, let me get these markings off of here. But the fact is, red denotes a bearish session, green denotes a bullish session. But if you wanted to, you could trade it, change it to purple and gold. And as long as you knew which color you were using for bearish and which color you're using for bullish, perfectly fine. In fact, you'll see some of the, I'm going to say, smaller brokers that their candle default is set at their company colors. And you have to go back and change to the reds and greens. You know, some people think it's cute. And it's okay. But if your personal preference was chartreuse and orange, that would have been perfectly fine, as long as you know which is bearish and which is bullish. So now we have the running of all the types of popular charts and my little essay and editorial on all of this stuff. But now we have our charts. What do you do with them? How do you start seeing opportunities to trade by using these charts? Well, the first thing, if you notice on my chart, are these levels of support and resistance. Now, we have whole classes of support and resistance, but support and resistance are prices, historical prices, where that price of an asset, the last time it was trading 10 times ago, last year, 3 years ago, when it was trading at this price, that it either got stuck or did something radical. And those lines were drawn on the charts way back when, or you could go back and look for them and draw them on your charts now, and they're extended way into the future. Because when we know a price where the asset gets stuck at in its move up or down, or the price point that was crucial in that movement, in the past, we might use that to predict what price would be crucial in the present time. Now, there's many ways to get these support and resistance levels. You can use Fibonacci levels. You can use pivot points. I use what I call eyeballing. I think it's the best way, and it's what makes you a better trader than the guy sitting next to you. Eyeballing means going back and looking at your charts historically and seeing where these price points were. Okay. Not where the price is today. I mean, you're going to analyze where the price is today, but these prices have been drawn on my charts, some of these as many as 3 to 4 to 5 years, and they're projected forward. Now, it's only been in the last year that the euro has been trading down at this level. Now, the reason I have the gold level, I have the dashes, I have the dots, I have they are my personal key. They're not your key. You have to come up with a system that once you put these on your charts, how you interpret them, unless you want to keep going back in the past to see what was important. Okay. So these let me know A solid line tells me that was a good solid price, and it's been that solid price every time this asset is traded in this range. Dashes mean to me that they are an important level that has been broken before. But we can see, look how important this level was at this price. Here, here, here. Not all the time do they hold. But in the progress of movement of that asset on this chart, we would like to know what is the next price point that would be important to traders. Or let's imagine, let's go back to my thought process. I believe that price is completely random. Price jumps all over the place. The price and the trading is made up of millions and millions of people all over the globe making millions of decisions. And it's completely random. But there are certain times, because most of our trading will look like this, a mess, sideways congestion, a bump up, a bump down, a price here, a price there. But price is a mess. But there's certain times when price starts developing non-random behavior. This non-random behavior happens when price is trending. When price starts moving in a trend, it becomes non-random, and you can explain it, you can understand it, and you can use it to your advantage. Price should be, because see what happens is price takes a lot of momentum, takes a lot of traders, a lot of conviction, a lot of people pushing to start moving a price up. But as more and more people jump in the market to push that price up, it gains momentum. The more momentum it gains, it gets to be like a train, like a locomotive. It starts building up steam on the tracks. Well, once you've got all that lumber thrown into the boilers and the steam coming out and the train's chugging along, moving at 30 miles an hour, it's very hard to stop it on a dime. Okay. You try to stop it on a dime, most likely you're going to throw the wheels off, the train's going to come colliding down. It's going to take a long time, even if you throw the brakes on, for that train to actually stop. So if we can see when price has gathered that momentum, we can then make certain decisions about what we can expect the market to do in our short-term lifespan. Now, we couldn't predict this, and at this point, we don't know if this asset is going to come down here or it's going to recover here, but we're looking at a 1 hour chart here. Right here, we had 12 hours. We actually had 12 solid hours of solid momentum, solid upward movement, okay, that we could have found a high probability potential opportunity. Okay, I don't want you to trade in this mess, although some of you want to trade in that mess. But here again, okay, because price can move in only 3 directions. It can move up, it can move down, and it can move sideways. But you see, it can also move up in a horrible, ugly fashion. That doesn't help us either. Okay, this doesn't really help us. What we need, and believe me, there's enough assets out there, whether you're just a currency trader, whether you're a stock trader, whether I only trade the euro and its crosses, that's it. Okay, there's enough assets at all times that you'll find trending, that you can find this. You don't need to trade continuously. You don't need to look for outrageous things. Your charts are telling you what price action is telling you. To analyze this, we might then want to look at these support and resistance levels. That'll help us understand. When we saw a price moving up here, okay, it stayed supported, and there's all this point. It was supported by this 106.82. It started moving up, chugging and chugging and chugging. Okay. And as it should have done, it should have slowed down and stopped at this resistance level, because that's a price point that traders were looking at. Okay. When it broke that resistance level, we might have found an entry point to trade it up to here. Now we see when it hit this support resistance level here, it's gotten a lot of trouble. So I would have gotten out of the markets. I could have gotten in somewhere here, gotten out there, and made a nice little profit. I've done this without any involved technical analysis. I've used my charts. I've looked at my price. I've interpreted what the market's doing, and I use support and resistance and trends. Now, sometimes you need more than that. You might want to go on to apply chart pattern. Now today, life is really easy, okay? Because you can do things like adding triangle chart patterns directly on your charts without having the old days of having to see them, draw them, and understand them. You can drop them right on charts. Well, these chart patterns can help you make decisions, because you might be looking for a breakout. Now, I understand we're talking about lots of general terms here. We have specific classes, or you can go on to our YouTube channel and watch whole 1 hour classes. Some people have asked about support and resistance. I can't tell you on there 10 1 hour classes on support and resistance. There's no way I could teach it to you in this class. So you have to do a little bit of the legwork yourself. Now, there are ways, like I said, that you can add support and resistance automatically on your charts. You can use things like Fibonacci's. You can use pivot points. But again, like I said, applying support and resistance levels that you look for and research individually on the chart by looking back at historical charts and historical price movements, by just, hold on a sec. Going back and looking at what happened when price was trading at this price point in the past. Like I said, with the euro dollar, it's only been the last year that the euro has been at this level, but we can go back and discern. Now we're back here now, back over a month ago. Well, we can see when the euro dollar came up to, look at how good this gold dash line held here. Okay, it held here. Okay, if you look at my dotted line, they've been drawn on the charts for, like I said, each time they got formatted a long time ago and projected forward. But you can go back and research these all you want. But it's up to you, because what I'm saying is there are mechanical systems that will put these on your charts, but they're not going to be your support and resistance line. They're going to be some mathematical calculation, such as pivot points, that use the open, the high, the low, and the close to drop these on your charts. But now what we have is we have some pieces of information available. To confirm what you're looking at on your chart, you should always be looking at volume. Volume should always confirm what you're going to do. Because if the volume doesn't support the price movement, and okay, I'll answer this one also. I'm sorry, I speak plain English, so I'm very bad at foreign names. but Yoya. Okay. The YouTube channel I'm referring to is Alvexo. You're here for class sponsored by Alvexo. You would go to the Alvexo YouTube channel. Now, when you add volume to your charts, volume should support any decision. If other traders aren't buying when you want to buy into the market and volume is decreasing, guess what? The market's losing momentum. People don't believe in the move. So therefore, you should be reconsidering what you're doing. Now, I'll explain volume a little bit to you because it's a little bit confusing in our industry. If you're trading stocks, since every stock is traded through a stock exchange, every transaction is calculated, and therefore volume is true. You can see on NASDAQ exactly how many shares of Google traded every minute of every hour, because every trade is facilitated through that exchange. Gold is always traded through the London Metal Exchange, the London Metals Exchange, the CBOT, and we can actually come up with the exact number of contracts that were actually opened and made during those time frames. In derivative trading, especially CFDs, and for Forex, no matter where you're trading, because there is no exchange, there's no centralized exchange for Forex. There's no way that anybody knows any volume for Forex because there's no centralized exchange. So how many euros are traded for how many dollars? And then in derivatives and things like cryptocurrency, there is no exchange that you could get this information from quickly. Now, the fact is, every trade should be, not just at Alvexo, every trade is put through a liquidity provider. Okay. Believe me, if you're dealing with scam companies, that's one thing. But when you're dealing with regulated providers, they're not sitting there trading against you, and they're not sitting with all your trades and jiggling the figure. All of those trades are going off into liquidity providers. They're the ones where the numbers actually come from. They're the ones who are taking the other side to trade, and they're taking the trades. Okay. There's many major liquidity providers. So the volume that you see on your charts is provided by the liquidity providers. Now, there have been studies done, and there is a true relationship between the volume provided on your charts through the liquidity providers and the volume happening in the total markets. So even though this bar chart for volume isn't the total global volume, it does give you the output of what the liquidity providers are putting through their liquidity, their pools. Therefore, it is considered to be a true representative of overall volume. So I'm not looking to see there's 997 million shares or euros traded. I'm only looking to see if the volume is up or down, if the volume has been increasing or decreasing. So now that we know we have our price chart, we have our levels of support and resistance, we have volume, we have trend lines or trends. Now there's a difference between a trend line and a trend. A trend is a general price movement. Where a trend line is a rule-based system that has to be drawn on your charts following a set of rules. I don't particularly look for trend lines. I look for trends. This is a trend. Okay. Now, when we're not exactly sure, okay, I'm going to answer somebody here again because it's the worst information I've ever seen. And if this is what the person thinks, they need to be corrected. With Forex, the spread can give an idea as to the volume. Higher the spread, the lower the volume. No, that is completely erroneous information. Okay. Spreads are based on what the dealer sets between the buy and the sell. A spread is higher for assets that are lower trading, not that the volume is lower. The more exotic an asset, the less liquidity pools there are to put them through. So therefore, you're dealing with smaller liquidity providers who are charging a higher fee to the broker, who's then charging a higher spread. So in other words, some bot of Vietnamese currency is only traded or provided with a few liquidity pools. So the spread is higher or lower. The spread has nothing to do with the volume of the trade of the asset at the moment. Okay. The spread on the euro US dollar doesn't increase because the volume jumped up. So please get your understandings and your definitions correct, because based on what you just told me, you'll lose your shirt in the markets. Now, once we have our volume, our trend lines, our support and resistance levels, maybe our chart patterns, which include everything from triangles to all types of pennants, flags. But these are things that we draw on our charts. On our charts, we then might still need help understanding what the markets are saying. This would be the time that you would add an indicator. Okay. Because an indicator only interprets what the market is trying to tell you. It's an interpreter. So if we were to add on MACD, let's move these back up. Let's get a bit of volume. Okay. So MACD is one of the most popular technical analysis indicators, okay, which helps us then see momentum, see overbought and oversold limits, to see the speed of the markets, and to get trading indicators or signals. Now, there's many different types of indicators and oscillators, but supposedly when we get a crossover over the lines, or a crossover the zero line here, that gives us a buy or a sell signal. Okay. Now, what it did is right here at this point, it generated a buy signal. Okay. Right here, it crossed over and gave us a sell signal. So it was telling us to get out of the markets. We also see the strength of the movement, and we can see whether the market is overbought or oversold. So what we're doing is we're building for ourselves a step-by-step plan for understanding and looking for opportunities in the markets. And by slowly putting this together on your charts, you can gather entry points, exit points, stop loss points, and calculate your risk management and make smart trading decisions. Okay. A simple approach, not a complex approach, not an overly complex approach with all these indicators and oscillators and mathematical formulas that you're going to get lost in. If you can understand what you're looking at in price, interpret it, support it, you can make a intelligent trading decision that's got high probability and high potential opportunities. And on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. And I hope we learned a little bit tonight. And once again, have a great trading day. Bye now.